Have you ever noticed that the biggest changes in financial history rarely begin with a dramatic headline? More often, they begin quietly, a policy adjustment, a shift in central bank behavior, or a market that stops reacting the way everyone expects. Then, months or even years later, people look back and realize the turning point had already arrived. I want to begin today's documentary with a simple observation: gold has been sending signals that many investors are overlooking. Not because they're hidden, and not because they're secret, but because most people are focused on yesterday's story instead of tomorrow's trend. Over the past several years, investors have watched inflation surge, interest rates climb at the fastest pace in decades, and geopolitical tensions reshape global trade. Conventional wisdom suggested that these forces would produce a straightforward outcome for gold. Instead, the market has behaved in ways that have puzzled both experienced analysts and first-time investors. So the question isn't simply whether gold will rise or fall next. The more important question is this: has gold's next major move already begun while most investors are still waiting for confirmation? Stay with me, because the answer isn't based on speculation. It's based on publicly available information, historical patterns, and the behavior of institutions that manage trillions of dollars. This isn't a story about predicting tomorrow's price. It's a story about understanding why some of the world's largest financial institutions continue paying close attention to gold, even when headlines suggest investors should be looking elsewhere. And that's where today's story becomes far more interesting. While financial media often focuses on daily price swings, something quieter has been unfolding beneath the surface. Central banks have continued accumulating gold. Governments are paying greater attention to strategic resources. Concerns about sovereign debt, inflation, and long-term monetary stability haven't disappeared, they've evolved. Former Federal Reserve Governor Kevin Warsh has repeatedly emphasized the importance of confidence in monetary policy and the long-term credibility of financial institutions. While opinions differ on markets, one principle remains remarkably consistent: confidence is one of the most valuable assets any economy possesses. History offers an important reminder. Every major monetary transition, from the collapse of Bretton Woods in 1971 to the global financial crisis of 2008, looked confusing while it was happening. Only later did people recognize the signals that had been there all along. I'm not suggesting history repeats itself in exactly the same way. It rarely does. But history often rhymes, and when familiar patterns begin appearing across inflation, central bank behavior, government debt, and investor psychology, they deserve careful attention. So in this documentary, we're going to separate headlines from evidence. We'll examine what history actually teaches us, look at what central banks are doing, not just what they're saying, and explore why many long-term investors believe the next chapter in gold's story may already be unfolding. Because by the end of this documentary, the goal isn't to convince you that gold can only go higher. The goal is something far more valuable: to help you understand the bigger picture so you can make better informed decisions in a world where uncertainty has become the only constant. Before we begin, I have one question for you. Do you believe gold's next major move has already started, or do you think the market is still waiting for its real catalyst? Let me know your thoughts in the comments below. Now, let's begin by understanding why gold is flashing signals that many investors may still be missing. If Chapter 1 was about asking whether gold's next major move has already begun, this chapter is about understanding why more experienced investors are starting to pay closer attention. The answer isn't found in a single chart, hidden inside one economic report, or driven by one day's market action. It's found by connecting several developments that, on their own, may seem unrelated, but together begin to tell a much larger story. Let's walk through them one by one. The first is inflation. Although inflation has cooled from its recent peaks in many developed economies, prices remain significantly higher than they were just a few years ago. For most families, the difference isn't theoretical, it's visible every time they visit a grocery store, pay an insurance bill, or plan for retirement. Official inflation numbers are important because they provide a standardized measure of price changes across the economy, but consumers experience inflation differently. They don't calculate it from spreadsheets, they experience it through everyday life. When the cost of essentials rises faster than incomes over long periods, people naturally begin asking a different question: how do I protect the purchasing power I've spent decades building? That question has echoed through every major inflationary period in modern history, and it's one reason gold continues to remain part of the conversation. The second development is government debt. Across many advanced economies, public debt has expanded dramatically over the past 2 decades. Governments borrow for different reasons: economic stimulus, infrastructure, national security, and financial crises. Debt itself isn't unusual, but as it grows larger relative to economic output, investors begin paying closer attention to how that debt will eventually be financed. Will economies grow fast enough? Will taxes rise? Will inflation gradually reduce the real value of outstanding debt? Or will policymakers find entirely new approaches? There are no simple answers, but uncertainty itself often influences investor behavior. The third development may be the most important, and perhaps the least discussed. Central banks continue holding gold. This is one of those facts that anyone can verify. Despite enormous changes in technology, finance, and global trade, many central banks still maintain significant gold reserves as part of their national balance sheets. Even more interesting, several have continued adding to those reserves in recent years. Why? Not because gold generates income or pays dividends, but because it has historically been viewed as a reserve asset that isn't directly tied to another country's currency or government obligations. That distinction matters, especially during periods of geopolitical uncertainty and shifting monetary relationships. This brings us to another important point. Many people assume gold only performs well during periods of crisis, but history paints a more nuanced picture. Gold doesn't simply respond to fear, it often responds to changing expectations about inflation, interest rates, currency strength, economic confidence, and perhaps most importantly, confidence in the long-term stability of financial systems. This is why experienced investors rarely evaluate gold by asking only one question: what happened this week? Instead, they ask, what larger trend may be developing beneath today's headlines? That mindset helps explain why former Federal Reserve Governor Kevin Warsh has frequently emphasized the importance of monetary credibility and long-term confidence. Markets don't simply react to facts, they react to expectations about the future. When those expectations begin shifting, even gradually, asset prices often respond long before the broader public notices. Now, none of this proves that gold is guaranteed to enter another major bull market. Markets are never that simple. Gold prices can remain volatile, interest rates can change, and economic conditions can improve faster than expected. These are all real possibilities. But the combination of persistent inflation concerns, elevated government debt, ongoing central bank gold holdings, and changing geopolitical dynamics creates an environment that many long-term investors believe deserves careful attention, not panic, not speculation, but attention. Because throughout financial history, the most significant market opportunities rarely announced themselves with perfect clarity. They emerged quietly, while most people were still debating whether anything had changed at all. And that's exactly why the next piece of this puzzle matters so much. If gold signals are becoming more meaningful, we also need to understand the broader monetary environment they're emerging from, and few people have spoken more thoughtfully about that environment than former Federal Reserve Governor Kevin Warsh. So far, we've explored why gold appears to be sending signals that many investors are beginning to notice. But markets don't move because of gold alone, they move because of something much larger: confidence. Confidence in central banks, confidence in governments, confidence in currencies, and ultimately, confidence in the financial system itself. This is where Kevin Warsh's perspective becomes particularly interesting. During his time as a governor of the Federal Reserve, Warsh witnessed one of the most turbulent periods in modern financial history, the 2008 global financial crisis. He saw firsthand how quickly confidence can disappear. Banks that had existed for generations suddenly faced enormous pressure. Credit markets froze, liquidity evaporated, and markets around the world experienced levels of volatility few investors had ever seen. The lesson wasn't simply that financial crises happen, history had already taught us that. The deeper lesson was that modern financial systems depend on trust. When confidence weakens, markets often react far faster than policymakers expect, and rebuilding that confidence can take years. This is why Warsh has consistently argued that monetary policy is about more than adjusting interest rates, it's about maintaining credibility. Because credibility influences expectations, and expectations influence everything from borrowing costs to investment decisions. Think about it this way. Imagine two neighbors applying for the same mortgage. One has spent decades building a reputation for paying every bill on time, while the other has repeatedly missed payments and borrowed more than he could comfortably repay. Both may ask for the same loan, but lenders view them very differently. Why? Because confidence changes behavior. The same principle applies to economies. When investors believe a country's monetary system is disciplined and predictable, confidence remains relatively strong. But when uncertainty grows around inflation, debt, or long-term policy direction, investors begin reassessing risk. They don't always react dramatically, often they simply become more cautious. And that's where gold quietly enters the conversation. Not because gold replaces modern financial systems, but because it has historically existed outside them. Unlike paper currencies, gold cannot be created through monetary policy. Unlike government bonds, it isn't someone else's liability. Its role has never been to generate income. Its role has traditionally been to preserve purchasing power during periods when confidence becomes more fragile. This distinction is often overlooked. Many commentators reduce the gold market to a simple question: will interest rates go up or down? While interest rates certainly matter, experienced investors know the picture is much more complex. Gold responds not only to interest rates but also to expectations about inflation, real yields, currency stability, geopolitical uncertainty, and investor psychology. That's why periods that appear similar on the surface can produce very different market outcomes. Warsh has often emphasized another important principle: short-term market movements should never be confused with long-term structural trends. Financial headlines are designed to capture today's attention, but successful investing often depends on understanding changes that unfold gradually over many years. History offers numerous examples. The inflationary pressures of the 1970s didn't appear overnight. The housing bubble before 2008 didn't develop in a single month. Even the transition away from the Bretton Woods monetary system unfolded over several years before its long-term consequences became fully apparent. The biggest economic shifts usually begin quietly. They gather momentum beneath the surface while public attention remains focused elsewhere. Today's environment contains several characteristics that many experienced investors continue monitoring carefully. Government debt remains historically elevated across many developed economies. Central banks continue balancing inflation control with economic growth. Global supply chains are adapting to geopolitical tensions. And many nations are reassessing the strategic importance of critical resources, including gold. None of these developments guarantee what happens next, and it's important to be precise about that. Markets have repeatedly surprised even the most respected economists, and no single indicator can predict the future with certainty. But when multiple long-term trends begin pointing in the same general direction, they deserve thoughtful analysis rather than emotional reactions. Perhaps that's why some of the world's largest institutional investors spend far more time studying monetary history than predicting tomorrow's headlines. They understand something individual investors sometimes forget: markets don't reward certainty, they reward preparation. And preparation begins with recognizing the broader environment in which investment decisions are made. That brings us back to the central question of this documentary. If confidence is one of the foundations of every financial system, what happens when that confidence begins evolving? More importantly, what can history teach us about how gold has behaved during previous periods of major monetary change? Because if we're looking for clues about the future, history doesn't provide perfect answers, but it often provides remarkably valuable context. And that's exactly where we're headed next. If there's one mistake investors make repeatedly, it's believing that this time is different. Every generation tends to assume its challenges are unique: new technology, new governments, new financial systems, new economic theories. Yet when we step back and study history, we often discover something remarkable. The details change, the players change, but human behavior rarely does. Fear, confidence, greed, and patience have shaped financial markets for centuries, and nowhere is that more evident than in the history of gold. Let's begin with one of the most significant moments in modern monetary history, August 15, 1971. On that day, President Richard Nixon announced that the United States would suspend the dollar's convertibility into gold. For decades, under the Bretton Woods system, foreign governments could exchange US dollars for gold at a fixed rate. That system had helped anchor confidence in the post-World War II monetary order. But by the late 1960s, growing government spending, rising inflationary pressures, and increasing international imbalances placed enormous strain on that arrangement. When the gold window closed, the world entered a completely new monetary era. For the first time in modern history, major currencies became fully fiat currencies, money backed not by gold, but by confidence in governments and central banks. At first, many people assumed little would change, but history tells a different story. Throughout the 1970s, inflation accelerated, oil shocks disrupted the global economy, consumer prices climbed rapidly, and the purchasing power of money declined. During that decade, gold experienced one of the strongest bull markets in its modern history. It's important to be precise here: gold didn't rise because of a single event. It responded to a combination of inflation, monetary uncertainty, geopolitical instability, and changing investor expectations. Markets almost never move because of one headline, they move because multiple forces begin pointing in the same direction. Fast forward several decades to 2008. This time, the challenge wasn't inflation, it was confidence in the banking system itself. Major financial institutions faced extraordinary pressure, credit markets froze, and some of the largest investment banks in the world disappeared almost overnight. For millions of investors, it was a stark reminder that even sophisticated financial systems are not immune to crisis. Governments and central banks responded with aggressive monetary policies designed to stabilize the economy. Interest rates fell to historically low levels, and liquidity increased dramatically. These actions helped prevent an even deeper collapse, but they also changed how many investors viewed monetary policy. Gold once again attracted attention, not because it generated income, but because it represented an asset outside the traditional banking system. Then came another chapter, the global pandemic. Massive fiscal spending, extraordinary monetary stimulus, supply chain disruptions, and a resurgence of inflation to levels many developed economies hadn't experienced in decades brought familiar questions back into focus.